like to introduce Mark Pace, who also has, for many years, been part of a transformative movement in the insurance industry, an area that frequently has been occluded, that we don't have as much transparency as we like. The insurance companies seem to have whole departments to try to figure out how to do arcane descriptions and elements and policies. And Mark has been really instrumental, and I've worked with him in our family for many years, and has really become the advocate to counterbalance the power of the insurance companies. So, Mark Pace, I'll leave it to you.
Very good. All right, guys, let's wake up. I know it's not going to be easy, but hopefully we can get this exciting presentation going. Who remembers 1977? I mean, some of those great memories from back there. 1977 happens to be the year in which I got started in the financial services industry. And in and around that time, I started in a financial planning approach. So there were loads of mutual funds, loads of broker-dealers. Yeah, well, you join one, they go under very shortly thereafter. And, of course, lots of life insurance companies. So that's how I got started. Yeah, right. And that's before the more recent lawsuits. I couldn't get the graph all the way up until today of the mutual fund industry, but if you look back there at 1977, by the way, this is in trillions, it was a blip. I do happen to know the number for 1977, though. It was $50 billion in mutual funds. Now, 1977 was also a very prominent year because that's the year I first started hearing about the whole concept of charging a fee to manage mutual funds. Very, very unheard of concept at the time because all you virtually had were loaded funds. Now, by the way, at that same time, the life insurance industry had approximately $17 trillion in assets out in the field. Today, as you guys know, that line's continued up. What do you think's happened with the life insurance line? Do you think it's gone up, gone down, changed? It's been flat ever since. So all the sales that are going on today are more or less just replacing the old business, and very little new business is ever being sold.
Now, are you talking about on the permanent side?
Just total.
Okay.
Yeah. It's been a dead industry literally since about the mid-'70s, early '80s, which is not good. And actually, I'm on a mission to try to help it out. Oops, how did that happen? Because I believe when there's an immediate need and desire for liquidity at the time of someone's death, life insurance is, in fact, one of the greatest tools ever invented for the creation and transfer of wealth. Obviously, when you've got that immediate need and desire. Shouldn't be sold, as it's sold quite often just because someone can make a commission. But when it's there, it's great. So any of you, raise your hand, have you ever worked in and around life insurance? Any of you actually sold life insurance? Okay. Have you ever had the experience that you sold a product and somehow or another, after you sold it, years went by, and it didn't exactly act the way it was explained to you when you sold it? Yep. Has your client ever come back to you and said, you know, this isn't exactly what I thought I bought, and had some confusion about what they bought? That's, again, it's fairly common. And the industry is a master at that. Let me tell you, I can't stand to see any asset that my clients buy or hold that they desire to have work, not work. And life insurance as an asset class is, by and large, been one of the most abused and underperformed asset classes on your clients' balance sheets. And it drives me crazy. I cannot stand, because we're nationally renowned, to get these kind of phone calls. Some lady calls us up. Her advisors told us to give us a call. She bought a policy 15 years ago. She's been religiously paying the premium for $34,000 a year every June. And she just got this notice. It's the 1st of December. And it says if she doesn't send in $65,000 in the next 60 days, the policy's null and void. Well, how did that happen? And the answer, for those of you who understand universal life, it's out of money. It's out of gas. She's 83 years old. She's uninsurable. And forensically looking back, that policy would have worked with just an extra $1,000 a year. No fun. I don't like to get those phone calls. So I'm here to make sure you can solve your client's problem cases and make sure it never happens again. I'm also here to create greater growth and value for your own business valuation proposition. And I'm also here to make sure that whatever you do, you look good, your clients feel good, and everyone wins in the equation. So if you wish to work with us, I'm only looking for a few good men or women. By the way, I do have a woman on there, not to leave you out. And so why should you care? Well, you can add higher value to your own business and potentially, depending on the regulations within the state in which you exist, and that's a caveat we all have to pay attention to, add existing fees to your existing practice model. You can always enter a new entry point, because I find that people who have advice, and good advice, at least available within the financial planning model, about life insurance, it potentially gives you another entry point for conversations with your clients, particularly your high net worth clients. And you can prevent your clients from being harmed and losing money, again, back to the thing I'm passionate about and I can't stand to see happen. And again, come up with new solutions to your problem cases. By the way, whenever people talk about life insurance, you immediately revert to the sales organizations. By the way, those sales organizations have created some of the slickest, best marketing tools to go in and review and replace life insurance. It's been going on for 30 years or more. That is not what we do, okay? This is not the review it, and then because I've reviewed it, I automatically got to tell you got to buy new coverage. Our mission has always been helping people buy and manage life insurance in a manner that makes it work at its very best. We provide a fee-based, proprietary, fiduciary-level, actuarial-driven advisory services to create an exceptional buying experience when people want to buy new life insurance. Talk to Mike and Bonnie. They can relate some of those buying experiences. Provide ongoing management to ensure that optimal performance takes place throughout the life of a policy. Again, Mike and Bonnie can attest to that. And rehabilitate existing coverage where your clients have old coverage that needs help. By the way, most of them do need help. Our mission has always been to rehabilitate the life insurance so it works at its very best. That's actually how we started. And we migrated over to the acquisition side because we began to discover is that the tools we were using to make them work better after people had acquired them, if they had been using those tools on the front end, they never would have needed them on the back end. Again, it was a learning experience for us. Our proprietary technology always utilizes, if needed, two particular probability analysis. Those probability analysis have to do with the longevity of the insured and the performance of the product, the internal property rights, if you will, of any given contract. We call it Life Insurance Property Management, LIPM, and we deliver it through the ObjectiveView system. We deliver the very best today. We have many people that are beginning to copy us, but they have, to this date, been so focused on still selling new coverage that they're not really trying to copy us that much. Available for optimizing the financial performances over the life of a policy. Our 6 pillars, which, by the way, I'm also in the process of trying to develop both for the CFP and for the CLUs, a protocol for what an insurance advisor should do if they're going to do their job appropriately. By the way, it's almost near done on the CFP side. We're getting a lot of difficult work on the CLU side. But this is what we use internally. Always make sure that there's an appropriate amount and period as dictated before any acquisition is made. By the way, because of the way we do business, we are rarely called in to do this. We're usually called after the fact. Very large estate plan. They've already dictated they need a $50 million acquisition, a $100 million acquisition. It's already been told to us. We're called in to do the rest. Make sure that there's a right product type or a mix of types. By the way, if any of you want some of the white papers that I've written on this particular topic, it is available and we can have them for you. They are long and they are detailed. But just as you guys would not go in with a single asset class, particularly on larger estates, larger acquisitions. We feel it's appropriate to have a protocol where you have risk tolerances, time horizons, all sorts of things documented, and then you make the appropriate product type or mix of types for that particular case. Once that's done, making sure that there's correct underwriting. We find that quite often that is done in error, particularly as people get older and their health impairments. And no matter what these agents tell you about how great a deal they did and how well they shopped the market, quite often maybe it wasn't the best underwriting that could have been had. Again, rational internal pricing and crediting rates, including carriers' quality of the ratings. But more importantly, being able to dissect those internal pricing and crediting aspects are extremely important. You guys are here with Dimensional because of the way they operate. Do those costs have anything to do with performance? Obviously. Same holds true with life insurance, and yet that's the one place where you're going to get more argument from the carriers than any other place, and also the highest propensity to try to protect that information. We do have methodologies that we can cut through that. Once you have all that, then and only then, particularly on the indeterminate premium products, which are most of the products that have made up the sales for the last 30 years, universal life, if you will, then and only then can you come up with an effective funding level. Once that's done, you still have to keep up with this stuff over time. You guys would not encourage your real estate clients to go out and buy a $20 million commercial building and put the deed in the safe deposit box, come back 30 years later and expect to have a good investment, would you? You have to look at what's going on. You have to investigate what interest rates are doing, what the occupancy is doing, what the tenant rate, turnover, creditworthiness of the tenants. All those things have to be paid attention to. Well, guess what? Life insurance is actually a very complex form of property. So we're in the business for making life insurance work at its very best because it is this unique form of property with this, by the way, most people do not get this. Hopefully you guys will. All right? It is constantly sold as a simple commodity. Pay a premium, get a death benefit. It hadn't been that. It's never been that, but that's how it's always been sold because it makes the sales process easier. But what it really is has every single particular property, every single policy is a unique property. And because of that, there are these complex and flexible, oftentimes, internal property rights that can only perform at their best when it's properly acquired and actively, ongoingly managed. By the way, for those of you who've sold life insurance, what do you think is our most difficult form of property to manage? Whole life, variable universal life, equity index, guaranteed universal life? Give me a guess.
Equity index.
Whole life. You know why? It's got the most flexible property rights of any of those product types. All right? Right behind that would be guaranteed universal life. The shadow accounts and those various aspects are very, very difficult to ascertain and micromanage. So it's interesting. What you might think as truth is not necessarily what's true when you get in there. So what people think they're buying is a simple commodity. By the way, I used $100 million of coverage. Obviously, we work on much smaller cases, but that's not uncommon for us to work on one that size. And I've got a $2.5 million premium, which means we're dealing with someone who's at least 60, 65 of age. Life expectancy is what the industry always throws at you. So what is that? That's when half a given population of a common class is deceased and half the population is still alive. It's not when people die. By the way, that's what most people tend to think. So by the way, would you take a 50-50 probability chance for any investment? Not a good deal. All right? And yet that's where everyone focuses your attention in the life insurance industry. That's why you get those short selling deals you were talking about at lunch, right? That's what they think they bought. But because they bought something and forgot about it, those property rights that are highly vulnerable to compound deterioration when they're not being looked at do in fact occur. And what that means is quite often, this is what's going on. Quite often, even before life expectancies are occurring, the policies are failing. By the way, for most product designs, getting away from the traditional Eastern Mutual whole life arena, which those products are still designed for longevity, the average life expectancy by design, in other words, the actuaries are designing in this particular concept, is 8 years right now. So in other words, their optimal profitability is for a product to only last about 8 years on new product designs, all right? So there are opportunities in all of this if you just know how to take advantage of them. So when life insurance is not properly acquired and managed, we find that 90% of the time, it's not performing as well as it could. In other words, there are areas that are underutilized. And what does underutilization mean? It means money is leaching out, opportunity cost that's hidden, that your clients could have been utilizing for their own benefit. They've paid for these rights. But every year that goes by that they don't utilize them, they're gone forever.
Could you give us an example?
Tons of examples. You can have policies that have crediting rates that are still at 5 or 6%. And that might be the first one by guarantee. That might be the first one that someone would come in and tell you that the policy is not performing on the illustration, therefore we need to get rid of it. Or your Eastern Mutual contracts where people have borrowed from them during rough times. Many of those contracts have direct recognition provisions in their dividend clauses, which mean that there's a double penalty as long as that money is borrowed. We had a case just recently, 2 years ago, because I remember those numbers vividly because they were so big it shocked me, that by repaying a loan, which the trust had the resources to do, to a Northwestern Mutual policy, there was a cash-on-cash return in the first year, not to mention the compounding that takes place over time, of 10%. Now, 2 years ago, what was a 10% return guaranteed like? Was that a good deal? Yeah. All right, but that's the type of thing that's out there all the time. And there's many, many, I mean, we can get into a lot of them as time goes on. So we can't stand to see this money lost. By the way, that last one I gave you, that's not something that Guardian or Northwestern or anything is going to be encourage their agents to go tell, because that's their highest performing safe block of money on their portfolio. That's where they're making the most money, all right, on their loan portfolio, because of the compound. They're not only getting the 6, 7, or 8%, but they're also giving the bumper on the dividend restriction. Huge return for them, double dip. All right, but I can't stand to see this money wasted on particularly such a potentially valuable investment. The other thing we've discovered is that in our own work over the last 12 years is that 75% of the time when we look at a property, a policy, it's the one they should keep. They're good. They're great. Sometimes they're phenomenal compared to what's available in today's market, and yet that's not what you hear from the industry. Every year, every new policy is better than the one before, and what does that mean they should do with the old ones? Cancel them, get rid of them, churn them, sell a new one. And yet we don't see that at all. We see some of these old policies are phenomenal if you just knew how to go back in and take advantage of the property rights. So, by the way, we can't promise this, but if you get with us early enough on old properties, usually we can rehabilitate them and make them work. Now, does that mean they have to come up with more money? Yes, unless they're willing to drop their face amount, which is another option. But we're able to show quite often that those internal rates of return on the new money funding, because the property was so good and had been left for so long, are sometimes phenomenal rates of return on the funds invested. By the way, we're very good at delivering that message. Agents can't stand to go out and have that conversation because, number one, they don't get paid for it unless they're going to replace the policy. And number two, they're usually going in and trying to tell someone that what they sold them 10, 15, 20 years ago that they've got to put more money in, sometimes twice what they were putting in before, is not something, that's not good news. It's no fun. They're not getting paid for doing it, so will they do it? Not going to do it. If you go on and hire us early enough, and by the way, we're getting hired more and more on new acquisitions, then generally we can make the property perform even better than it was originally thought of or designed. And by doing so, not outperform other investments, but at least get them more in line with those other investments, at least through life expectancy. Now, obviously, if you have a good portfolio, much longer periods of time, We're not telling you life insurance is better than other investments, but it has its place, and if it's there, it's supposed to work. So let's make it work at its very best. So let me give you a quick case study. We have many of them if you want to go to our website. It's www.objectiveview.com. There's probably 8 different case studies on the front page of the website that you can look at. This is just one. But looking at this one, it gives you some of the dynamic of, say, dual probability analysis on a more complex form of property, which is variable universal life. So what we find is most of the time we're dealing with this underfunding scenario. Only about 1 in 10 are we able to deliver the good news that you've actually put more in than you need. All right, so 90% of the time it's the bad news story, but we're generally pretty good at turning it into good news. So here's the case scenario. Husband and wife, they were both age 67. Small policy, $3 million. It's 10 years old. It was a variable UL. They had originally started funding $31,000 a year. By the way, this was one of a portfolio of about 8 different policies. Son of the owner of the business. It was a big manufacturing concern in the Carolinas. CFO of the company was the co-trustee with the son. There are 2 sisters. The estate plan, the classic, son gets the business. Let's figure out how to balance it out for the 2 sisters, all right? So my first question to the son as we got into this scenario, I'm going to get to in a minute. By the way, they believed the policy would last age 100 when they bought it. It was a 12% projected VUL, and obviously they have gotten wise. By the way, this case story is about 5 years old. All right. By then, they were projecting it at 8%. Again, it's not the way you should do it, but that's what they were doing. All right, so let's go through this dual probability analysis, and this is our unique way of explaining this. All right, what you see here, and it's hard to see down here, but right there, that's 101, that's 100, that's 104. Right there is about early 90s. This is the cumulative probability of death for a healthy population. Our numbers, not life insurance numbers. By the way, these are much longer than the numbers you're going to get from the insurance company. All right. We use totally different actuaries. Same actuaries the companies subscribe to, but they don't necessarily use in their illustrated work. All right, so what this shows you is if I have a healthy couple, we're not doing any adjustments to this curve, what's the probability of both deaths? And you're going to see it's about 96. 50%. Where the 50% line, that's what's known as life expectancy. All right, so for you guys that are doing planning work for your clients, let me tell you this. Once your clients start hitting the 60s and 70s, and your clients, if they ever saw a curve like this, they're going to, I will tell you, we've done this for 10 years or more. The typical answer for planning purposes from a client is usually 85 to 90% probability, not 50, once they understand it. Where was that? We're out in well over 105. So we're dealing with populations of people who are going to live a long time, particularly for your own planning work and distribution planning on your funds. Keep that in mind. All right, so anyway, I could do my work off of, and by the way, it cuts our costs dramatically, if you just want us to do this probability analysis off of the healthy curve, because we're not having to do anything other than pull our own data, knowing the ages and birth dates of the client.
I don't understand what you're saying. You're saying there's a 85% chance probability of
This is a 50% probability of death for both of them. This is 85%. So I can ask the client, do you want me to use a healthy curve? By the way, I can use an impaired curve.
Where are they going to die?
I don't know.
I understand that, but statistically, where are they going to die?
That's what I was just telling you. Well, you don't know where they're going to die. If we use this curve, assuming they're both healthy, half the population is deceased at 96.
So half the other 50% of that population.
Still here. Or at least one may still be here. That's the numbers.
Well, wait, so that's your probability,
Of both being deceased.
so it's not the exploding, so both of them.
No.
are 96.
One.
One of them.
I only need one. I only need one. Well, there's a 50% chance. of
Do you think there's
couples.
a 50% chance? of-
I don't think, those are the, those are the numbers, and they are moving this way every year. That one will still be here. Yes.
So, Mark, I think you hinted at this. The number I've always used with my clients was 92,
Right.
meaning the average age and the second one's going to pass away.
That's what you were talking, that's actually what this is.
Okay, but yours has shifted a little bit. So, give me a little bit of background on that. Like, what
Well, no, not,
slightly. I mean, you're looking at 95 or 96. 'Cause
yeah, it just has to do with what table you were using. This is a pretty refined table. It's actually the Bragg table, and it's probably more indicative of your clients. Higher net worth clients are going to have probably an extra 3 or 4 years automatically over even insurance data, and probably closer to 6 or 7 years over the general U.S. government tables.
Mark, on
Yes.
that chart, if you go all the way to the right, what's the age that's hard to read under where the curve, the green line ends?
Here, it's 104. So in other words, still like a 2% probability of, you know, somebody still being here at 104. All right. Anyway, that's the standard curve. We could do our work on that. All right. So that's the first question I pose to the client. The client goes, no, look, both mom and dad, and by the way, if even one of them was pretty healthy in the mid-60s, which to us is still young, we would probably encourage them not to pay for the more refined study that generates this red line, right? But the client said, no, look, mom and dad both have health impairments, so go on and do your full-blown actuarial study, all right? What that means is we gather up all the medical information, think underwriting, but without getting a physical. So in other words, we're going to, if they're in a nursing home, we're going to interview the gerontologist, we're going to take socioeconomic data on the client, what type of occupation they have, what kind of net worth. We then also going to pick up all the medical information on that client. We're going to send it to at least 2 actuarial firms, sometimes 3. We're going to get it back. We're going to create the report based upon that. By the way, the son was right. Both his mom and dad, for age 67, to see that kind of shift to the left, had some pretty good impairments. So he was right. Plus, he was dealing with a large portfolio, and it wasn't just about this policy. He wanted the answers to a lot of other stuff. So there's that first side of the probability curve. All right, let's look at the other half of the equation, which is the probability analysis in and around the policy. For those of you who've worked with VUL, the only way these things can be run from a home office perspective by regulation, so it's not the, you know, that your agent's a bad guy, this is the only way he can get it done, is he's got to put in some rate of return, constant rate of return. Now, I'm talking to an audience that gets that's ludicrous, particularly given the fact that depending on how the portfolio is invested, it's either going to be up or down, and it can be up or down with huge standard deviations in any given month. And on top of that, unlike your normal investments where there's just maybe once a quarter a management fee coming out, these things every month there's a fee coming out, which creates a degradation to that portfolio, particularly in the down months. All right? So, but the point is, they could have run it at 6 and the policy would lapse here. They could run it at 10, the policy would make it here. The point is, that's how a standard illustration comes from a company. That's not how this policy is ever going to work. So some 20 years ago, I got with, you may know Dick Weber out in your area of the country, but I've worked with Dick quite a number of times. In fact, the last white paper we were joint work on. We used the Monte Carlo simulation that he came up with, and what it does is we can take any portfolio. Obviously, we're not trying to track it exactly. This is by no means an exact science, but we're trying to get close because we're trying to come up with a more appropriate funding level for a given policy to make it work with a high probability. What you're seeing here is at the 9th year, if you keep putting 31,000 and we do the Monte Carlo simulations, one of those trials failed, all right? And I'm just accumulating the trial failures, all right? So we're looking at the probability of the policy working now, all right? Now what you're seeing is by the time the standard illustration lapses, I've had 90% of all my trials fail. Not putting enough money in that policy. Now, by the way, you could figure that out by just the illustration, all right? But you're not going to come up with an appropriate funding level just using the illustration systems, and we've known that for years. So what you're seeing here is a very confusing chart, but it's where I go back into the client and I say, look, now we can fix this thing all sorts of ways. First way we can fix it is we can keep your funding level the same and cut your death benefit. But what you've got to answer for me is think defined benefit pension planning. You've got to answer a couple of questions. Do you want me to fund to the green line or the red line? And where on that line do you want me to fund to? Do you want it to be at 50%? Do you want it to be at 85%? Do you want it to be at 100%? I don't care. You got to give me an answer, though. He said, give me high 80s, or at least show me what high 80s look like. By the way, that's normally the answer. Whether it's a trustee, a client themselves, it's usually between 85 and 95. That's the answers they give. I've only had one case, it was a large corporate case where we were dealing with lots of policies, where the CFO said, run it at the 50% probability, all right? And actually, that sort of makes sense. But for any individual life, it doesn't. All right, so the next question is that you've answered the probability on one side, you've got to give me the probability on the policy side, too. You want it to be at 100% when you hit the high 80s on death? In other words, or do you want it to be high 80s on both? He said, show me high 80s on both. So that's what this is.
You're talking about probabilities, not age.
Correct. Yes?
So I'm assuming that within this, in order to do that calculation, you have some sort of estimate of returns in that.
We're using Monte Carlo simulations off of market performance based upon the underlying portfolio of the products currently invested in. In other words, we can mix it or change it. So, but it's not as refined as you guys would use on your Monte Carlo simulation. It's simply going to be equity and bond.
Okay, and so you have a rate of return, you make adjustment allowances for like fee costs and stuff that are in there?
We do that automatically based upon the given product. Yes. Yeah, and we can make further adjustments, just as you guys can do with your Monte Carlo simulation. If you want to put caps or limits to performance because you feel the market going forward is going to be less.
No, it'd be more of just like they're consistent underperformance. So
You can do that. You can do the same thing. All right, but in either case, this guy said, keep the death benefit the same, show me high 80s, and we're going back delivering this message that, you know, to get those kind of numbers, you've got to start putting about $65,000 a year in. All right? Now, with that said, we charged about $15,000 for the work, all right, which, by the way, is 50 basis points on that particular case compared to the death benefit. But that's a one-time fee. It's not an ongoing fee. The client decided to go with the 85% probability on both. It required the funding of $65,000, and we're going back in and charging $3,000 a year with that particular performance number is based upon the fact that every third year we're going to go back in and redo the longevity analysis. All right? They could have priced it without that, and it would have probably been around $1,400 a year, $1,495 or something like that. Now, for those of you who understand life insurance, here's what you're going to come up with. That's a bad deal because you've just gone in and told these people to double the amount of money they're putting in that policy. Why don't you just replace it with a 1035 exchange, start all over, take that cash, roll it in. That's how an agent's going to approach that case and get a new commission. Well, when you look at the impairments to that particular case, you could do that, but the probable funding on that new policy would have been $90,000 a year. By the way, if you go out to that 85% life expectancy and you do that $90,000 a year from age 67 out to the 85% probability, that's a 2.1% return on the death benefit. So, guaranteed, not a bad return in today's marketplace, but is it the best thing that could be done? We candidly think that's spending good money on poor results. By the way, if we had funded that policy to $90,000, the numbers go nuts, all right? Bec- Yeah. Well, you don't. No, you don't. You actually you let it grow and let the corridor kick over. That's actually the best way to make the thing work. Yes. All right. And that's what's going to happen. Any of those policies that were working, the average death benefit of the Monte Carlo simulations had a $10 million death benefit by that 85% life expectancy. Because the only ways they're working is they had to be growing enough to overcome the insurance cost at older ages, which is how VUL actually should always be sold, but it's not. I mean, they were sold for quite a number of years as a low-cost alternative to permanent life insurance. You guys get this probably better than most audiences. Life insurance guys have a hard time with this one. But in either case, that's about a 12% return on that funding level, and it's about a 16% return on the marginal funding. When the trustee sees this, that CFO, do you think he suddenly thinks this is a bad deal for those funding?
No.
Going forward.
What is the 12% return?
That was the going forward return of $65,000 invested over the next period to get the $10 million death benefit.
That's assuming you're starting, that's
Today.
65 starting from zero.
Starting today.
Starting, yeah.
That's the deal.
So it's
So
really,
you're
It's
saying-
good money.
You're saying everything you spent up to this point is zero, and you're not
Right.
taking it into consideration.
Well, right, you can take that into consideration. You're still going to get a really respectable return.
That's the IRR on the death benefit.
That's the IRR on the death benefit from this point forward on the $65,000.
so you actually should be taking out the current cash value because it's a dollar.
It depends on who you're dealing with, and we certainly can do that from any given time, but just to make it simple, that's a, yeah. All right, in either case, let's look at what we're dealing with here. This is how we see and what we've learned. For years, we have been the guys to go to for this technical stuff. And in the first 5 or 6 years, if you had to take a guess, how many new clients do you think we got on a regular basis just because we were the best technical people in the world? Not many. I wish it were 2 a month. All right, and what we discovered is you can be great, and we are. And everybody that ever sees our stuff at the highest levels, whatever group I'm speaking to, tells us that. But it's not going to get you new business. All right, so let me share with you some other things we've learned. It is really all about this relationship and relationship management. Yes, you've got to have a great service. I'm sure everybody in this room does. A great service model, a great value proposition. But if you do not figure out how to manage the relationship process of acquiring, keeping, and manage those great clients, you're not going to get anywhere. Now, particularly because of our particular way of doing business, we're generally dealing with a complex group. I mean, in any engagement, I'm usually dealing with the financial advisor. I'm dealing with the CFO many times of a family office or a big corporation. I'm dealing with the tax attorney. I'm dealing with the corporate attorney. I'm dealing with a lot of different people. By the way, I have only spoken to, and I think Mike and Bonnie noticed this at our last engagement in New York, I've actually only had to go meet the actual insured on our bigger engagements twice. Because I rarely have to talk to them because they're protected by all these other people that are doing that. But that means you've got to have all sorts of processes for managing that diverse group of people. And of course, Mike and Bonnie with their business model are great at it, I can tell you that. And you saw just the beginning of their service offering on the last presentation. And once you do that, you've got to have world-class service. I mean, if you can't back up what you've told people and keep it going, then you're going to fail. And finally, you've got to have an accountability structure. If you put all these things together, which we have been doing diligently for about the last 7 years, we've got something that works. By the way, whenever someone brings a case to us, this is how it works. First thing we do is we set up what we call a relationship protocol. Relationship protocol is set up with that advisor, whoever that key advisor who's bringing the case to us. Because we have to know how you're dealing with your clients. Where do you fit within that dynamic of the advisory team? Once we know that, We then begin to set up a case protocol, and the case protocol is generally managed by the relationship protocol. And sometimes the relationship protocol and the case protocol will change the next time you get a different client from the same advisor. But without knowing that, you don't know how to manage that relationship. We then do the case. Once the case finished and everybody's happy, we go back and have an accountability review to see how we did and what improvements can be made to any of our processes going forward. I would encourage you within your own process building, within your own business, begin to look for opportunities to do something like this. Our goal is to partner with a few exceptional advisors across America. We are not trying to be everything to everybody, and we have our own particular methodology for entertaining who those advisors are. We will take cases from any good advisor, but we're not going to partner with but a few exceptional advisors. Those exceptional advisors by themselves generally fit a criteria as follows. They have their own world-class technical capabilities. In other words, I don't care whether they come from the legal community. We have quite a few in the tax attorney arena. I don't care if they're family wealth managers. I don't care if they head family offices. It doesn't matter their background. They could be a CPA, but generally they're very good already reputational-wise at what they do. They have great relationships with their clients. They're successful. They have unimpeachable integrity, and they consistently work with high net worth clients in a manner in which they have an advisory role about life insurance. I mean, if you're not having those conversations, then working with us, if you don't have the clout to match us up, it's not going to work. I mean, it just doesn't. And they share a passion for life insurance. You guys can relate. There are a lot of investment guys. I've spoken to the FPA. I've done national presentations. There's some guys that just can't stand life insurance, and we're certainly not going to work with them. But I also want people who really are passionate about making sure that the assets that are in your client's portfolio work and work at their best, and that money's not leaching out. They're generally in business a long time. They're engaged in this high-end estate planning, and they also have those ongoing conversations we talked about, and they're willing to go out and work with someone else. There are a lot of guys that are stars, and their only way they can be a star is by excluding everyone else. Well, we can't work with folks like that. But those who know how to create the chemistry for teamwork, we guarantee you this: we're not in the business like life insurance agents are. They want to be the star. I mean, you bring them in, they usually want to take over everything. It's a need, by the way, they have on their profile, most of them. All right? And that is true. They really do. They need that relationship. They need the relationship even more than the money. It's not the money that drives those guys if you look at the studies. But we don't do that. If you bring us a case, it's your client, you're going to be the star, you're going to stay the star. We're just going to show up, do our thing, make sure that everything works well. But if you do think that you're one of these particular advisors that could be an exceptional advisor working with us, we have an onboarding process for that. We have done that for some people in the room, and they can speak to it. But basically, we begin by having an opportunity conversation. We want to find out if there's a match. And if there's a match, we then get into, if needed, and usually it is, something we call the positioning polisher, which is all about developing an appropriate message for you in your marketplace. The reason we do that, and we discovered this was extremely important, is because particularly when you get in and around this conversation about life insurance, because it's been led and given by big-time life insurance guys, particularly on these bigger cases, is if we're not careful about protecting your position, particularly for the attorneys, they can stumble and say or do something that can annoy the wrong person. And in annoying the wrong person, hurt their business model. And we don't want that to happen. So by doing this, we're not only helping them develop their business proposition, but we're also discovering what it is, so as we begin to work together, we can protect them as we have client conversations. After that, we are, in fact, looking for cases to work on. Once we work on a case and do that, this particular area right here usually is a loop that runs for a year or two. Because we find that as people begin to work on their own message, they begin to go back and change their websites, they begin to change their documents, they begin to change all sorts of things, but in a very positive manner. And it's not something you can do overnight. Once we do that, though, we stand ready with something we call the message multiplier. And the message multiplier is all about each of you recognize the way you get your best clients is by going out and having your best client talk about you to another best client. And there are, in fact, ways that as you've built this, you can begin to do this consciously. It's how we build our business, and it's how we encourage anyone that we're working with to build their business. So, in conclusion, if any of you are interested, you all probably have business cards. I run 4 webinars a year. They're open, they're broadcast nationally. If you're interested in being on our email list, give me your business card, write friend on there. By the way, our next one's coming up next month. It'll be highly detailed on the internal costs, and Barry Flagg and I will jointly do that presentation. I don't know if you know Barry, but he's Veralytics, the old insurance advisor. Who's out of Florida? You're out of Florida? He's down in Tampa. If you have a case, write case on your business card. If you're interested in exploring further opportunities, this exceptional advisor proposition, then write advisor on there, and I'd be happy to help you at least have a conversation to see what's going on. Obviously, I'm here today and this evening. I probably will have to get back tomorrow because we're taking the family to London in place of our Florida trip for the summer. So won't be here tomorrow, so try to catch me today if you would. Any questions? I'm doing okay on time?
I just have one question.
Yes.
You're talking about the internal costs, you know, and with all the life insurance policies that are sold, they show the current charges and the guaranteed charges. What's your feeling, or what have you seen? Have you seen companies migrating towards guaranteed charges? I haven't seen
The industry norm is pretty simple. Other than a couple of, when Conseco did its aggregation of quite a number of smaller carriers, there was some slight, and it was very slight, internal current cost increases. To date, there has not been the propensity to do so. That's not to say that it won't happen. I mean, the industry is under a lot of pressure from profitability, but a lot of those old blocks are sort of dying off anyway. So, you know, it's right now we're still doing all the comparisons based upon the internal current costs, and we're not seeing anybody rush to make that first move. Any major carrier for sure on the internal pricing, but it could happen. I mean, it could well happen, but I don't see it near term. Other questions?
When you do your comparisons, you said usually it's best to stay with the existing policy. And
Yeah.
have you done that comparison with any of the no-load products?
Actually, the no-load products, regrettably, because I was one of the beginning, I was one of the people who actually sort of tried to lead the movement toward no-load. The problem we have with no-load, particularly because I'm dealing with usually larger cases, is from a retention and underwriting and various other things, it's not something we use. I have used no-load from time to time, but the misconception is that commissions are what make up the problem. They're not. On a product design, commissions make up such a small component of the overall design component to a product that the load or no load really long-term, particularly in the protection business, doesn't make much difference. It could be, you could see some difference when you're dealing with front-end corporate work, but most of the major carriers now have designed products that you can go on and dial down comp, which we do quite often. That's a part of our value proposition, particularly when we're doing those larger cases. And I didn't get into our portfolio design concepts, but that's how we justify our fairly large fees compared to some of the work that's been done when we get involved. So the answer is I'm very familiar with the no-load products. I tried to, 10 or 15 years ago, actually help with designing many of them, and regrettably, we don't have very many that are all that great compared to the existing products. In other words, it's not an automatic alternative, regrettably. Any other? Thank you.